In March of 2009, the S&P 500 closed at 676, and today, that number looks like a statistic. But back then, that number felt like a warning sign, because the world wasn't just nervous, it was shaken. Major banks had collapsed. Retirement accounts were cut in half. Unemployment was rising sharply. People weren't checking their portfolio for gains. They were checking it to see how much damage was left. Financial news wasn't debating growth. It wasn't talking about opportunity. It was debating survival. And yet, that exact moment, when fear was at its highest, marked the beginning of one of the greatest wealth-building periods in American history. Over the next 15 years, millions of regular people quietly became millionaires. Not hedge fund managers, not Silicon Valley founders, teachers, nurses, engineers, small business owners. And here's the important part. They didn't become wealthy because they were smarter than everyone else. They became wealthy because they were positioned. They were in the game. They stayed in the game. And they let time do what time always does when you're invested in productive assets. And today, we are living through another structural shift of similar and potentially greater scale. This time, the number is $124 trillion. The 2009 case study. Let's go back for a moment. Imagine being 40 years old in early 2009. You've spent years saving $50,000 for a home down payment. Not by getting lucky, by being disciplined. You said no to vacations. You said no to upgrades. You said, I'll do it later, again and again. Then you turn on the news and you see financial institutions collapsing. Friends are losing jobs. Neighbors are losing homes. You hear phrases like systemic risk, global recession, financial contagion, and the market has fallen more than 50% from its peak. Now imagine investing that entire $50,000 into a broad S&P 500 index fund during that chaos. That decision at the time would have looked reckless. It would have sounded irresponsible, because in the moment, nobody knows where the bottom is. Nobody knows what's coming next. But from that March 2009 low through early 2026, the S&P 500 rose over 900%. A $100 investment became roughly $1,000. And it didn't just rise quietly, the index crossed. 2,000 in 2014, 3,000 in 2019, 4,000 in 2021, 5,000 in 2024, 6,000, and then 7,000 by 2026. But it wasn't smooth. There were crises along the way: European debt turmoil, government shutdowns, trade wars, a global pandemic, inflation spikes, rate hikes, a bear market in 2022. And at every stage, there were reasons to sell. Every stage had a headline that made quitting feel responsible. But those who stayed invested accumulated significant wealth. Between 2010 and 2024, the number of millionaire households in the U.S. nearly tripled. That wasn't luck. That was long-term participation during structural expansion, introducing the $124 trillion shift. Now here's what most people aren't fully processing. Over the next 2 decades, approximately $124 trillion in assets is expected to transfer in the United States. And I know that number sounds unreal, so let's be clear. This is not speculation. It's demographic math. The baby boomer generation, one of the wealthiest generations in history, accumulated homes, businesses, investment portfolios, and retirement accounts over decades of economic growth. They built wealth during an era of expanding markets, rising housing, and the long-term compounding. And now, as this generation ages, those assets begin to transfer, first to spouses, then to children and grandchildren, and a portion to charitable organizations. This event is commonly referred to as the Great Wealth Transfer. It is the largest intergenerational wealth movement ever recorded. To put $124 trillion into perspective, it is more than 5 times the total U.S. pandemic stimulus. It exceeds the economic output of most nations combined. And here's the key: it will not happen overnight. It will unfold gradually over roughly 20 to 25 years. Meaning, this is not one event. This is a multi-decade environment. And environments shape outcomes. Why this is not just an inheritance story. Here's the critical misunderstanding. Most people hear wealth transfer and assume this only benefits heirs. But inheritance alone will not create most new millionaires. Because wealth that transfers does not sit idle. It moves. It gets invested. It gets redeployed. It reshapes markets. And even if only a fraction of that $124 trillion flows back into equities, real estate, private businesses, and investment vehicles, that capital supports asset prices over time. And who benefits from rising asset prices? Anyone already invested. That's the point. This is exactly what happened after 2009. Capital inflows, stimulus, and expansion supported asset growth. Participants benefited, spectators did not, and the same principle applies here. Not because the situation is identical, but because the mechanics rhyme. Money moves, assets reprice. Those positioned capture the upside. Ripple effects explained when trillions move, 4 things happen. First, asset support. Reinvested capital increases liquidity and long-term demand for productive assets. It doesn't mean markets go straight up, but it does mean there is a structural tailwind behind assets over time. Second, real estate divergence. Some regions will experience supply increases as inherited properties enter the market. Others will experience intensified demand as heirs upgrade or relocate. So the market doesn't move evenly. Geography matters more than ever. Third, business expansion. Inherited capital funds acquisitions, startups, and expansion. That increases hiring. Hiring increases income. Income increases investing. And the cycle compounds. Fourth, industry growth. Estate planning, financial advisory, trust management, tax strategy, and wealth services will expand dramatically. Because when money moves, someone has to manage it. Someone has to structure it. Someone has to protect it. Someone has to deploy it. Capital movement creates infrastructure demand. Infrastructure demand creates career opportunity. The psychology parallel. Now here's the pattern most people miss. In 2009, fear prevented participation. Today, distraction prevents positioning. People are focused on inflation reports, rate cuts, elections, short-term volatility. Meanwhile, the demographic engine continues turning. No one rang a bell in 2009 marking the bottom. No one will ring a bell announcing the midpoint of the wealth transfer. Most wealth windows only feel obvious in hindsight. While you're inside them, they feel uncertain. And that uncertainty is exactly why so many people miss them. Because they wait for clarity. And clarity usually arrives after the biggest gains are already underway. Practical positioning framework. So what can a regular person realistically do? 1. Maintain diversified market exposure. Broad, low-cost index investing remains the most reliable participation tool. Not because it's exciting, because it's repeatable. 2. Maximize tax-advantaged accounts where possible. Compounding without annual tax drag accelerates long-term results. Over 20 to 25 years, tax drag is not small. It's massive. 3. Increase contributions as income rises. Most people don't become millionaires by making one perfect move. They become millionaires by increasing the size of their consistency over time. 4. Maintain liquidity. Downturns during the transfer period will create dislocations. Liquidity creates optionality. Optionality creates opportunity. 5. Align skills with capital flow. Industries serving estate management, wealth advisory, financial infrastructure, and asset deployment are positioned for long-term growth. 6. Think in decades, not quarters. The wealth transfer spans roughly 25 years. Short-term volatility matters less than sustained participation. Historical context. The United States has experienced several major wealth creation eras, as post-Civil War industrial expansion, post-World War II housing and middle-class growth, the 1982 to 2000 retirement-driven bull market, the 2009 to 2026 recovery cycle. Each era created large numbers of new millionaires through participation in structural growth. The Great Wealth Transfer represents the next structural phase. It is not driven by speculation. It is driven by scale. $124 trillion will move. Markets will adjust. Opportunities will emerge. The only question is who participates. In 2009, opportunity looked like chaos. Today, opportunity looks like demographic math. 15 to 20 years from now, there will be millions of additional everyday millionaires. Not because they predicted perfectly, not because they avoided every downturn, because they positioned early, because they stayed invested, because they treated structural change seriously. History will document this period clearly. The wealth transfer is already underway. The uncertainty isn't whether it will happen. The uncertainty is who will benefit from it. And that decision is being made quietly, every single month, by people who choose to participate.